So it's a little difficult to understand how things are. I mean, year on year, it's actually not a fair comparison. You tell us, as you're stepping into the second quarter, is there more momentum on the order visibility? And what about execution, the pace of execution and conversion to revenue?
Thank you, Surbhi. Thank you for having me on the show, and a very good morning to you. See, as you already said that, compared to last year, it's not a fair comparison because last year in the Q1, our construction had virtually come to a halt. But I think we've informed the stakeholders earlier also that our engineering and procurement did not suffer. Similarly, even in this particular quarter, the first 2 months definitely had an impact of COVID second phase. More so, that we could sustain that because we have learned the new way of handling the things both in the execution front as well as in the engineering and procurement. So it goes with minimum disruption. So in that case, I think definitely we have done well this thing. But even sequentially, if you see, our PAT has grown and our revenues are almost the same in Q1 compared to what it was, pre-COVID. So we are back on track. Our execution, we feel that it's now gaining pace. And in coming months, and maybe this year, unless there is any untoward wave coming, COVID wave coming, we foresee that, our execution will gather pace and will definitely have a decent growth in this particular year. Now, coming to your second part of your question, which talks about our order inflow. I think you have already seen in the first quarter, we got this order, which is from Russia, which is around 165 million USD. I think it's not just one order. We have opened a new geography, and we feel that where CIS countries, we will have more traction in coming months. We are seriously bidding for some projects in CIS where traditionally we were not there.
Okay.
Going forward, I think municipal orders, we see now the traction is happening on tenders. So definitely municipal orders will also come in from next quarter onwards. So we don't foresee that this year. In fact, we only see that our order book will only get further strengthened in this particular year, which will result into a better execution also.
Okay. Rajneesh, good morning. By better, if you could give us, any numbers. So how's the pipeline looking both in domestic market and in export market?
I think I may not be able to give you any numbers because since last year, as you're aware, we are not giving any guidance because of uncertainty of COVID. But definitely we see that, as I mentioned just now, that we were at 8,400 crore at the end of the year. Currently, we are at 10,400 crores in Q1. So by the time we end this year, definitely we feel that our order book will further get strengthened. Maybe you might see a higher contribution this year coming from industrial orders, and also the contribution which will come from overseas projects will be better. And when the contribution from overseas projects is better, definitely it results into a little better margins. At the same time, a much better cash flow. So in that way, we are very, very optimistic about it.
Yeah, Mr. Chopra, I mean, no doubt about that. I mean, even in a disruption year like FY21, you managed to grow your top line itself by 10-11%. So, full credit to your team. But what about the dip in margins? We've been noticing that. What is pressuring margins? And is that going to be a trend that continues even in FY22?
Okay. I think, Surbhi, you're referring to our dip in margin, which is around, 0.6% in Q1. And you're absolutely right about it. See, one of the reasons why you see that, there's a dip in the margin is because there is a higher cost of stay at sites. Because of COVID, we got extension of times. So there is no liquidated damages, on those contracts. But if our people are staying there more, and obviously because of new COVID norms, definitely we have our people, we have to spend more when people are there at site and, the work comes to a halt. So that is one additional cost. Secondly, although most of our contracts are covered by an escalation clause, but the higher cost of steel and plastics particularly, definitely there has been a little impact. But I'm sure, going forward in this particular year, I think we'll be back to our decent margins, and we are pretty sure about it because all our new contracts, they will not have this component of, price escalation which is there in the market.
Okay, that's important, yeah, that the new contracts will come with price escalation. When you're saying decent margin, a number if you could leave us with?
I'm afraid, Surabhi, I may not be able to give margins. Even when we were giving guidance, I think we have never given a guidance on the margin. All I can say is by end of the year compared to what we are seeing in Q1, I think this will be definitely much better margins by the time we end this financial year.
Sounds good. All right, Mr. Chopra, thank you very much for stopping by and giving us a view on the outlook for FY22. Thank you for joining.